Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin with our top story. Stocks on track for a fifth straight day of gains following a week of softer than expected inflation data. Darrell Cronk of Wells Fargo saying the following. As the S&P 500 makes news highs, it's important for investors to rebalance to avoid portfolio equity concentration risk. Trim tech and communication services to neutral weightings. Darrell joins us for more. Darrell, good morning to you.
Good morning, John.
What did you make of that opening exchange? Are you with us?
I'm with you 100%. I mean, so everybody knows the concentrated returns. I just ran the numbers yesterday. If you look at just the top 5 names, right, not the top 10, top 5, they're driving about 82% of the index, 13 to 14% year-to-date return. So strip that out, you're up maybe 2-3% year-to-date on the broad, level. But maybe what's more important is when you look at those names, the top 5, 10 names, the correlations are as high as they've been since August of 1997, right? So what's that tell you? It tells you that people are chasing, right? They're chasing those winners and continuing to feed into it. And to Lisa's very good point, if you take the NASDAQ 100 against the Russell 2000, so tech against small cap, 5-year wides. Right? I mean, we're at the widest level we've been. So, small cap continues to underperform, not surprisingly. I keep getting asked every conference room I go into, every meeting, when's it time to buy small cap? When's it time to buy small cap? And I keep saying, not yet, not yet, not yet, right?
When is the time?
The Russell 2 probably needs to be somewhere in the 1800s, maybe even 1700s before I think you get a compelling risk-reward flip there that makes sense, but nowhere here above 2000.
So why do you have this argument that you should be more concerned about concentration, since that's one, and more interested in some of the others that keep lagging behind?
I think because eventually you end up with this kind of, think of it almost like it's a Teflon market, right? Nothing seems to stick to it. Every risk that we roll at it, right? Whether it's, the France risks this morning and the tails or anything like that, just seems to bounce off of it, and the same theme plays through. AI wins, tech wins, right? It's 7 months into that. If you run a marathon or a race and you sprint for 7 months, which we have sprinted, let's be honest about it, you're going to be tired. And I think the market is tired here. It's, when you look at those top concentrated names, to the point they're doing extraordinarily well, right? And I'll take it. But I get under the surface, right? Whether your point equal weighted, small cap, I look at some of the other sectors, they're just not participating at the same level.
So I guess the question is, do you sell your big tech exposure, or do you buy everything else? It's a big distinction. Are you bullish on the other sectors, or are you just simply getting a little bit more skeptical of how much further tech can run?
So yes to the former, right? Which is, so I think when you get underneath it, we just released our mid-year outlook this week, right? One of the things we did in the mid-year outlook was took energy to the most favorable we could possibly take it to, right? In the portfolios. Basically, we ran it up to the highs. Big pullback, obviously, in oil prices. We've taken all the political risk premium out of oil prices, which kind of shocks me given the global landscape of where we are. I'm getting a lot of big, whether it's the integrated energy names or even some of the exploration companies at 12, 13, 14 times PEs with a 3.5% dividend. I will take that all day long. We also like materials. We think healthcare is a good value play here. And we would fade places like, the consumer, obviously REITs, and even financials look a little bit overbought to us here.
Wait, consumers, REITs, and financials. This is very interesting at a time where the Fed ostensibly is going to be cutting rates pretty soon.
Correct.
And at one point, this was supposed to fuel the next consumer spending wave in the sense of consumer strength and ability to borrow in a new way. Why is it not playing out that way?
Because I'm not sure the consumer is as strong as people want to give it credit for, right? I mean, if everybody does including us, the top 5 quintiles of income, right? We know that the bifurcation of the high end is doing well, the low end is not. But what people are missing is kind of the creep up into the middle income levels of where people are trading down for value. They're not spending as robustly as they want to. You see, consumer confidence numbers are still in a downtrend. Small business numbers are still, pretty ugly, right, when you get below the surface. So there's just not a lot of reason to believe, to us it looks like the consumer's kind of running that last mile here, right? They've been able to stay durable and spend. I'm just not sure how much gas is left in the tank, Lisa.
So this time last week, when we read out the payrolls number of 272,000, you didn't hear 272,000. You heard something else?
I think payrolls and the labor market in general are getting skewed heavily by some of the lag effects of what's happening with immigration in this country and everything else. So we ran the numbers again. If you take just immigration from pre-COVID levels, we're 3.3 million people higher today in the labor force than we were coming into 2020, if you will. That's having real impacts on the labor force, right, and those numbers. So the labor market is still strong. We'll take a 4% unemployment rate all day long, but I'm not sure that it's as strong as maybe the numbers might be sending a little false echoes there to us. This is what Chairman Powell basically said in the news conference. One of my sort of biggest takeaways from the polls over the last year is this poll right here. It's from Guardian Harris poll that came out in the last month or so, and it reads as follows. I'll give you some headlines. It's stunning. 55% believe the economy is shrinking. 56% think the US is experiencing a recession. 49% believe that unemployment is at a 50-year high. Wow. 49%. That's the poll that came from Guardian Harris in the last month or so.
It's the reason why consumer sentiment has been so low. People don't feel good. Is that wrong? Can you say that people's feelings are wrong, or are they feeling something that the numbers aren't showing in quite the same level? And people explain it by the K-shaped recovery. Stay tuned for the University of Michigan Sentiment Survey out in approximately 1 hour and 49 minutes.
Or maybe we're just not measuring things properly.
Correct.
Household survey versus establishment survey last week was the big standout, Darrell.
I think you're spot on, right? I mean, I think you've got to really, you can't just take those headline numbers as they stand, right? You've got to dig in under the surface and kind of take the second derivative, third derivative, and understand what those numbers are telling you. I am a big, firm believer that liquidity is masking so many things around the economic element. I mean, we just went back and ran the numbers from just the 2020s, we're now in 2024, obviously. Financial markets are up about $46 trillion in AUM, right? Government debt is up $12 trillion, right? Think of just the liquidity that pushes into the engine, right? And the ability for consumers to stay longer, right? For businesses to feel better, right? All of that has had this kind of long-lasting, call it the marathon effect, right? We run hard for 7 months, but Wall Street isn't Main Street, right? And so the S&P isn't what people are feeling if you walk up and down Main Street to the point of the survey, right?
49% believe the S&P is down for the year. This is quite a poll, isn't it? It's
well,
amazing.
Yeah, that is
a lot of the companies are down. So it also speaks to the non-AI members.
Darrell, this was great. It's good to see you, sir. Thanks for sharing your thoughts. Darrell Cronk there of Wells Fargo. Pooja Sriram and the team over at Barclays maintaining their call for one cut this year, writing, quote, "We continue to think the cut to take place at the earliest in September. Our baseline is predicated on inflation gradually moderating in the coming months on a sequential basis and the economy gradually slowing." Pooja joins us now for more. Pooja, great to have you with us on the programme. I just want to summarise the data we've had so far this week. CPI, cooler than expected. PPI, downside surprise, then jobless claims happened. Wrong kind of upside surprise. What did you make of the claims print yesterday, and how concerned should we all be?
Oh, thanks and good morning. I think, we really didn't take too much signal from the claims data. The fact that it did tick up for the week, I think if that trend continues, it would be in line with, some continued moderation in labor market conditions, which, really is a welcome sign. I think we should all remember labor market conditions are very strong, whether you look at, the 3-month moving average of payroll gains or even the latest payroll report. I think some moderation is welcome, particularly from an inflation standpoint.
Jeff, you earlier this morning from BNY said the market is more dovish than the Fed. It certainly seems that way based on the bond market rally that John was just talking about, and you could see that into some of the implied cuts. Do you think the market is wrong to be so? Or do you see that the Fed basically is trying to have a hawkish tilt just so they don't get it wrong, to reverse some of what happened at the end of last year when they indicated that they would be cutting rates?
I think, I think the markets don't necessarily price just the baseline. They've got to price, risks around that. So, the pricing is what it is. And as far as, what the Fed signaled, I think was a very balanced sort of a message. You're right. They have been burnt once, the end of last year when there was a dovish tilt in December after a run of, weak inflation prints. And then look what happened in the first quarter of this year. So I think just, they don't want to make too much of one data point. And the totality of the data that they keep talking about, whether it's activity or labor markets, those haven't really shown a material easing. And so, what they signaled in their SEP on Wednesday was very much a tone of patience, of caution, being cautious. And they want to gain confidence that things are moving in the right direction.
What do you make then of people who say, well, if you put it all together, core PCE, which is one of the key inflation metrics that the Federal Reserve looks at, is something that is very predictable if you have the inputs of PPI and CPI and some of the other data that's already come out. People are now mapping out something akin to a 0.1% increase in core PCE, which would be very much in line with the Fed's goals, bringing year-over-year inflation to something like 2.6%. How much do you see that as actually giving a green light to the Fed as early as September, even though that's not your base case?
So, look, I think we agree with that translation. Our own forecast for core PCE in May is a 0.13%. So to your point, a very benign, very soft-looking core PCE inflation print. That said, we like to say that the Fed is not data point dependent. And it came across quite clearly in Chair Powell's press conference as well, that they didn't want to make too much of one data point. He did say that, he welcomed the May inflation outcome, and that's the step in the right direction. So, like we've written, should inflation outcomes continue to, move in the right direction, i.e. come in soft, I think that will open the door to a rate cut. But is the May PCE alone enough? Clearly not.
Pooja, some personal bias here. I have to say, I wonder how many people agree with me. I'm far more interested in how we end the year on unemployment than I am on inflation. I sense from a lot of people that come on this programme, they have far less confidence about where this labour market will be by year end than they do on how inflation's going to track. And the reason I ask this question is because the Federal Reserve has come out and said, basically, we will end the year with unemployment where it is right now. And I'm trying to work out how much confidence you have that unemployment does actually stabilise at these levels through the next 12 months plus.
It's that's a hard one to forecast. We work with the indicators that we have, and clearly we haven't seen much by the way of a move up in the unemployment rate. Of course, we were at 3.4 at some point in time. We've definitely ticked higher, but a 4.1% is clearly not something that is, weak by any standards. And I think this is a labor market that is still running strong. We look at the data as closely as we can. Of course, we're cognizant a lot of the gains are concentrated in the private sector, particularly services, particularly, education and healthcare, some from leisure and hospitality. So we've heard those arguments that the gains are all, pretty narrow. But the fact that they continue, month on month is one thing. And second is, we're looking at the JOLTS data. Job openings, sure, have come down a bit, but still quite elevated. If anything, it looks like, that momentum is still there. So, we're looking for any signs of cracks. We haven't seen so much. We're sort of with the Fed that we don't see a big spike in the unemployment rate by the end of the year.
Pooja, appreciate it. Pooja Sriram of Barclays. Tesla shareholders voting to approve Elon Musk's $56 billion pay package and greenlight the company's move to Texas, the stock having a pretty decent 24 hours. Tasha, Keene of ARC, constructive on the name, writing this: our confidence in Tesla's ability to launch a robo-taxi network within the next 5 years has increased considerably. I'm pleased to say that we can catch up the Tesla bull right now. Tasha, great to catch up with you. I just want to start with the shareholder votes of the last day or so. Of course, they've been going on for a number of days. Do you think we can leave this issue in the past now and move on?
Well, I'm not a legal expert, so of course, we know what investors want, and now it could be up to the courts again. But what I'll say is that I think it's positive that we saw investors considering the proxy and putting their own votes in, voting for themselves. When we look at Tesla, we certainly want Elon Musk to be at the helm, especially when you consider the transition to fully autonomous driving, which is what we think will drive the majority of the value of the company over the next 5 years.
Can you walk us through why and why you think that's the real deal and we'll see it that quickly over the next 5 years?
Yes, well, so we already have robo-taxis, right? Waymo, which is Alphabet's autonomous driving project, is driving around Phoenix. They're, starting an effort in LA. They're in San Francisco, but we don't have them at scale yet. Tesla could be one of the first companies to offer a service like this at scale, and it's because they have a massive data advantage. They're collecting information from customer cars that helps them train their models, and they have more cars on the road than any other autonomous effort that I know of in the U.S. And this is their plan. They're layering on software updates incrementally. Right now, it's the full self-driving software that's available to customers. Eventually, customers will be able to take their hands off the wheel. And then last night, we heard Elon Musk talk about extensively the robotaxi effort, where you as a customer could sign your car up when you're not using it, but more likely, I think it'll be a fleet model. So you'll have perhaps another company that owns and maintains the fleet. Tesla collects a take rate off of the per mile revenue. And, I think this could have very attractive margins, higher margins than the current business model today, which is mainly selling vehicles, right? And this will be a recurring revenue. So again, we think very attractive from an economic perspective to Tesla. But more importantly, it'll change all of our lives. I think this is one of the greatest AI projects in our time, and we are so lucky that we get to witness it.
Tasha, there's some real questions about Elon Musk's leadership and whether he is focused enough on Tesla and diverting some of the chips that have honestly reportedly gone to some of his other companies to really get some of the robotaxi efforts fully underway. Why do you think that's not a concern?
I actually think it's a positive that Elon Musk runs a number of companies. One, we've heard them talk about this. It's great for talent acquisition. We've seen employees move in between his companies. If you're the top AI engineer in the world, you're not going to get bored working for Elon Musk. The chip story, what I point out is, automakers actually often negotiate on behalf of their suppliers, and they do so because of economies of scale. They have better negotiating leverage. So I think having, all of these companies that, many of which might use NVIDIA products is, again, actually a positive here. And we've also seen manufacturing innovations come from SpaceX that bleed into Tesla. And I think you have to look at the Tesla results here, right? When you're talking about the pay package, the stock has risen over 1,000% over that time period.
Yeah.
So he's really delivered shareholder value. And I'm, again, so excited for the future because we're really on the cusp of autonomous driving today.
Tasha, is there absolutely anything that could happen that is a potential event in the next year that could shake your confidence right now in Tesla?
Well, really what I'm looking for is for Tesla to cross that threshold into fully autonomous driving. We've seen them tease this robotaxi service or a ride-hail service, both on the past earnings call and at the event last night. So I'm looking for that launch. So we have an event coming up in August from Tesla that's going to look at the purpose-built robotaxi, the next generation car. I don't think they need that car to necessarily launch the service because their current fleet is capable of it. But I am looking for details at that event about what this business model will look like. We heard some of that last night, so we know that they're thinking through the back-end logistics of how this will work. So I think that, they could cross this threshold within the next year or two, and that is the catalyst that, I'm most looking forward to with Tesla.
$2,600 price target, which is pretty punchy, as you know, and certainly gets attention, that's for sure. Can you tell me the biggest risk factor associated with your call? What would change your mind?
Well, certainly I think that solving autonomous driving is a very difficult problem. It's hard to time that exactly. But again, as you mentioned, in our blog, which is on the ARK Invest website, we think that this could happen in the next 5 years. And our confidence has increased with all the advances in AI and Tesla's, improvements that they've rolled out to customers that actually own the vehicles and the software. That is a risk. Again, we're confident that they can do it, but it is a difficult problem to solve. I think, what gives us confidence from last night is, if this pay package gets totally approved, we know that Elon Musk is going to be at the helm of this company for at least 5 more years. He has limits on when he can exercise his options. So I think that is another key piece that we want Elon Musk to stay. We want him to be incentivized. So I think that's ultimately a good thing.
Who do you think controls the fate of this call? Do you think it is Tesla and their ability to execute, or do you think it is the regulator, local authorities, who will ultimately have the decision to make to give this the green light or not?
Great question. I was just going to touch on that. So often people are concerned about regulation. I actually think that, again, the more difficult problem here is actually making the technology work and scaling this type of service. The U.S. has actually been surprisingly lenient with autonomous driving because it's been up to the states. And we've seen, Tesla right now, they have over 1 billion miles cumulatively in the full self-driving software suite driven. So I think that they'll be able to statistically prove to regulators that this is safer than humans. And actually, we've done some research on this. So if you look at their full self-driving software suite, the last time they gave us a statistic, which is a little over a year ago now, it looked like it was 5 times safer than human-driven Teslas, and even safer than the average car on the road. So we're already seeing those proof points, and I think it could get even better. And in fact, Elon Musk has hinted that they have line of sight to maybe a 4x improvement on that, and that's what's going to matter to regulators here. So we're already seeing those safety points.
Tasha Keene, great to catch up with you. Thank you. Tasha Keene there of ARK Investment.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.